Hello and welcome to my retirement roadmap. This is the second video regarding taxes in retirement. We're going to talk about the different types of accounts for retirement savings. There are effectively three uh, types of accounts for savings in retirement. The first is tax deferred. That's we look at traditional IRAs, we have 401ks and other employer plans like 403bs, 457s, etc. So those are tax deferred, and these are the most common, where most people have saved for retirement, and it's a qualified retirement account. The second type we'll talk about are tax free. These are Roth IRAs and Roth 401ks and other versions of Roth treatment within employer plans. So we'll talk about that. And finally, the third type are taxable accounts. These are effectively brokerage accounts. Sometimes you refer to them as brokerage accounts. You also a savings account at a bank is taxable. So if you're getting interest, any investments where you're earning interest or getting a return on your investment that are not within a qualified retirement account, we call those taxable accounts. So we'll talk about these a little bit more, each one of these. Let's start again with tax deferred. This is the most common. They are, as I said, the traditional IRAs or 401k and other employer plans. The thing about these is when we save money into one of these accounts, okay, we're effectively making a contract with taxing authorities, and we'll use the IRS for example. We're saying, hey, listen, we are deferring this taxes. You're basically, it's almost like a loan. We have to pay those taxes back, and there is almost no way. There are very few ways of getting out of paying taxes when we do this. When we defer our taxes, the only way that I know is if we can give this money, if we give it away to a charity, a qualified charity. That's really the only way to avoid taxes, paying taxes on these qualified retirement accounts. And why is that the case? That's the way they are set up. And even if these 401ks, traditional IRAs, if they pass to beneficiaries, okay, like our children, grandchildren, etc., they are still taxable. So somebody's got to pay the taxes somewhere along the line. So if you don't pay for them, I should say, if we don't pay for them when we're alive, as we withdraw the money, our beneficiaries are going to have to pay the taxes. The exception, of course, is being if the money goes to a qualified charity. And also, just while we're talking about charities, this is when you're looking at being charitable, you want to make charitable contributions. This is typically known as the best place to give money to a qualified charity, is through our tax deferred account. If we're looking to give money to a charity, because it avoids that ordinary income taxes that come out of that when the taxes have to be paid. Also, the government, it's the Congress, they're the ones who make these rules up. They've been changing some things about RMDs, or required minimum distributions. What they're saying is, hey, listen, we've let you defer your taxes, but when you turn 73 or 75, that number's changing within the next few years. But for right now, people, if they turn 73, you need to start taking money out of your 401k and traditional IRAs to pay the taxes, because Congress wants the taxes. They definitely do. And so they have these required minimum distributions. Okay, so that's the part there with tax deferred. Let's go on to the next one in tax free. The Roth IRAs or Roth components of your employer plans, like a 401k. So they're not two separate, just as a distinction here. Roth 401k is part of the overarching regular 401k that an employer has. Okay, so they're not two different accounts. It's just there's Roth money within the side of that. Okay, and these withdrawals from a Roth account, these tax-free accounts, they are tax-free. They can be taken out. Now there are some rules around taking money out of a Roth IRA. And I'm gonna talk about it just here very briefly, and also note that these 5-year rules are, in my opinion, they are the hardest things to remember. Just super difficult to remember. But I'm getting a better handle on them. Basically, if you've made a contribution to a Roth IRA, so this is for a Roth IRA. If you've made a contribution, you can take that money, the contributions, the amount that you added there, you can take that out whenever you want, okay? Because you've already paid taxes on it. So that part you can take out. It's the earnings on those contributions that have to meet a 5-year rule. Okay, so that's one of the distinctions. So just keep that in mind. There is a 5-year rule. And also with Roth conversions, there's also a 5-year rule. With a conversion, you can't take the money that you've put into a conversion for 5 years. Okay, and just not to get too complex on this, but one of the reasons why they do that way is because if you just did a conversion from a traditional IRA into a Roth IRA and you could immediately take the money out, well, that would be a loophole. So that's why you have to wait for 5 years on your conversion before you take money out. And then there's also rules around the earnings that come out of these Roth IRAs as well. So probably I've given too much detail on that for this because I am trying to keep it a high level overview. But do keep in mind that Roth IRAs do have these 5-year rules that have to be understood and paid attention to, so you don't get yourself in trouble. With Roth IRAs, there are no required minimum distributions. That's there was a change because of 401ks. There were RMDs until just a few years ago. So now you don't have to take any distributions if you're the owner of those. Now, again, getting a little complex here, but if you're the beneficiary of a Roth IRA or the beneficiary of a Roth 401k, then there are effectively rules for when you have to take the money out. But we won't get into the details on that right now. Okay, so we've talked about those two qualified retirement accounts, tax deferred and tax free. And last but not least, there's a taxable account. Now, these are not qualified retirement accounts. A taxable account, because a brokerage account, let's say you have one at one of the discount brokers, Fidelity, Schwab, Vanguard, and you've got money sitting in there. Maybe you have some stocks. Maybe you have bonds. Hopefully not too much in bonds. But so you got money in a taxable account. These can be, in my opinion, these can be very, very challenging. And so they require a lot of attention. And when I have a client who shows up with a lot of money in a taxable account, it's like, okay, we really need to get we need to roll up our sleeves and really work on this. First of all, it's important to note that interest, any investments that are throwing off interest that will be taxed as ordinary income, we view those as inefficient in a taxable account. Okay, so ideally, if you're holding investments that are going to have interest, say for example tips, which is one of my favorite, you want to put those in a qualified retirement account, either the traditional IRA or a regular 401k or the Roth versions. Okay, so that's the thing, is the interest is inefficient. Then we have in the taxable account, we also, if we have investments in equities, even funds that have stocks in them, they can throw off dividends. Now, the qualified dividends, those get special tax treatment. But if they're non-qualified dividends, and believe me, we won't spend time in this video talking about what makes them qualified and non-qualified. But the non-qualified dividends, they act just like interest. and get taxed as ordinary income, which in a lot of cases, I mean, there's exceptions all over the place. It just depends on how the portfolio looks, but in a lot of cases, those are inefficient. That's why we try to avoid that. And as I mentioned, the qualified dividends, and also we'll talk about long-term capital gains. Those are taxed at lower rates, and that's where we can find some efficiencies here. But it takes time and effort to review everything that's in a taxable account and make that, make it work. So we're doing the right thing. I do point out also that mutual funds, if you have a mutual fund in a taxable account, you do have to be careful because those mutual funds can distribute these taxable gains unexpectedly. You don't do anything. You're just holding a mutual fund there. It's been growing. You're doing fine. And then all of a sudden you get a tax statement and it's like, wait, how come I owe all this money? I haven't done anything. I haven't sold anything. And yet now I have taxable income. So those are things that I particularly don't care for, having mutual funds in a taxable brokerage account. The ideal is to have a similar investment, if that's what you're looking for, in an electronically traded fund, ETF, because they typically are much more predictable about how the taxes are going to show up. One of the really good things about a taxable account is that there is a step up in basis at the death of the person who owns that. Okay. So that part there is, as opposed to say like a 401k or an IRA, regular ones, the tax deferred versions, when they pass along to the beneficiaries, they're still taxable. We talked about that. Okay. But not for these investments. So, for example, if a person has, let's say they have an ETF, we'll say a stock market, a broad stock market index fund in an ETF, and it's sitting in their account and it has gained a lot of money. Okay. But still, it's just sitting there. Let's say it's doubled in value. If the person passes away and it goes to the beneficiaries, that is stepped up. The basis is stepped up. So all those gains aren't taxable, as opposed to if that same investment was in a 401k or a traditional IRA, for example, they would be taxable. So that's one of the big benefits of having a taxable account if you're looking to pass money on to pass them on to heirs. Didn't say that quite, or beneficiaries. That's the sort of thing that we want to look at. So anyway, that is it's a very high level overview. I guess there's another thing I will dive into quickly. So I listen to this podcast regularly. I just really think this is very, very good. And these planners are on there, and the question comes up. So when a client shows up, and a household shows up with their retirement savings, what's your preference on the percentages in each one of these accounts? Okay, and I thought that's a really good question, and basically two of the three kind of came back with, well, it's nice to have a third and a third and a third. So a third in each one of these. And the reason why that is really nice to have as a financial planner and for tax planning, we're really talking about tax planning here, okay? So the thing that's really nice about having that is you can use those to your advantage, okay? I'll just give a quick example. For example, we've got money in tax-free Roth. You could really lower the income, just take money out of that, out of the Roth account if you're trying to keep your income low in a year for whatever reason. Okay? So you can use these different strategies to take care of things. Or another example we'll talk about later is if you're really trying to avoid hitting another IRMA bracket. You might be able to say, hey, listen, we've taken enough out. We're just going to have to go after the Roth for the rest of us so we don't trigger another IRMA bracket. And we'll talk a little bit more about that in a minute. So that's it. So that's why they were saying, it'd be nice to have a third and third and third. And one of the planners is like, oh no, the more you have in tax-free or Roth, the better off. And I'm just going to go out on a limb here and say that's my preference. I love having Roth money. It's just so nice to have because it's not taxable. We don't have to worry about tax rates changing, and also if this money goes on to our heirs, our beneficiaries, they don't have to pay taxes on it. It just makes things so much easier. Now, I'm not saying this is the right thing to do to put everything into Roth. I'm just saying that is really nice. And if I were to give an analogy, the best one I can come up so far, and I keep thinking about this because I love analogies. It's similar to flying, like the term is, in the front of the airplane. Okay, so for example, you're flying in business class. You're crossing the ocean. You're in the front. Everything's just taken care of. They're not going to nickel and dime you for everything. You don't have to worry about where your seat is. You're going to have a good seat. That's what I really like to compare Roth to. Now, again, the purpose of this series here is not to talk about Roth conversions. I have another video series just particularly about Roth conversions. But the point here is that Roth money does make things a lot simpler in retirement. And so as you do tax planning, definitely take that into consideration as to how you want to, if you do want to do Roth conversions, because in this current environment with tax rates being low and being made, quote, permanent, these low tax rates, the whole reason to do Roth conversions isn't as relevant as it has been in the past. So anyway, I think that's a good enough point here to make for now, and I will talk to you in the next video. Thanks.